Petty cash. What is petty cash? Simply put, petty cash is a set allocation of small funds that a company puts aside to pay for minor expenditures, such as postage or supplies. The petty cash is handled by a designated petty cashier or custodian. This person is responsible for the handling and authorization of payments made from the fund, as well as writing the appropriate checks. It is important that only one person is designated the role of petty cashier in order to ensure control activities are met, such as segregation of duties and the physical security of the money itself. Otherwise, it will be easy for theft to occur. Not all payments can be made by check, or some payments are simply more convenient to be paid in cash. Hence, this is why we establish a petty cash fund. A petty cash fund is established when a company checks the custodian a check. The custodian cashes the check and places it under their care. Now suppose Mary here, the custodian, receives $100 from her company to establish a petty cash fund. On the exact date, Mary would record this entry. Now petty cash is an asset account, so it increases while the cash decreases. Say for example, at the end of the month, Mary spends on a total of $85 out of her $100 for an allocated petty cash fund on various items such as postage and office supplies. She will then prepare the following report in order to replenish the fund. In order to replenish the fund, she will need to show the receipts in the fund in order for the company to bring the total cash in the fund back to its original balance, which is $100. Hence, the company will then cash a check of $85 to Mary in order for her to replenish the fund. This is shown in this journal entry. As we can see, the equity account of these expenses are debited to account their usage, while the cash account is credited in order to replenish the funds. In a real-world scenario, however, the total amount of receipts do not always match the amount of cash required for replenishment. This is called cash over and short. The custodian will lose receipts or obtain the wrong amount of change and will either have more cash on hand or less cash. This is known as human error and is inevitable. Such a discrepancy can be charged to an account called cash over and short. Now this is a temporary account and can either be debited or credited based on if there is an excess or shortage of cash. For example, in this report, we can see that there is a shortage of $2 as the cash requested to replenish the funds and the total receipts do not match. Hence, when Mary creates the journal, she must add another equity account called cash over and short in order to compensate for the shortage of the $2. In this case, the account is debited in order to make up for the shortage. Hence, Mary is reimbursed for $87 even though her receipt only shows $85.